This is not an accident. What a precious metals dealer just told me about silver isn't a surprise rally or a meme spike or a quirky commodity story. It's the predictable output of a machine that has been assembled piece by piece over decades. And the machine just entered the next programmed phase. And I'm going to make a claim so blunt it will bother people. When a monetary system is cornered between default and debasement, it chooses debasement almost every time. Not because it's evil, because it's politically survivable. And when that switch flips, silver is one of the first pressure valves to scream, because it sits at the intersection of money, industry, and trust. Stay with me, because in the next few minutes, I'm going to do three things. I'll show you the exact repeating pattern that shows up before currency trust breaks. I'll prove it with 3 historical receipts. And then I'll apply the same checklist to right now, so you can see why the dealer's big news matters before the mainstream catches up. First, the hard numbers, no vibes. The U.S. Treasury's debt to the penny shows total U.S. debt at about $567 trillion as of 2026, so 01/27. And the IMF's global debt database update puts total global debt around $251 trillion, still just above 235% of world GDP. Read that again. Those aren't just big numbers, they're constraints. They tell you the system can't simply grow out of this without either painful default-style outcomes or stealth default through currency dilution. Now here's the part that should make your ears perk up. Silver has been moving like a system in transition. In late January 2026, multiple outlets reported silver pushing into triple-digit territory, over $100 Oz, with even higher prints around the same window. So when the dealer told me new buyers are flooding in, physical is acting weird, I didn't hear gossip. I heard the sound of a system reaching the part of the cycle where it must transfer the cost of past promises onto the future, quietly, mathematically, and without a vote. And here's the retention test. Most people click off right here because they think this is just another metals hype video. It's not, because I'm not asking you to believe in silver. I'm asking you to recognize a pattern that exists whether you like silver or not. Here's the mechanism. It's fixed. It repeats across empires, republics, and modern central banking. Stage 1, the foundation. Money is anchored to constraint, metal, convertibility, hard rules, or at least a culture of restraint. Trust is high because limits are real. Stage 2, expansion. Credit expands. Governments promise more, banks lever more. The system learns it can manufacture growth by pulling demand forward with debt. Because it works at first, it becomes policy. It becomes identity. Stage 3, loss of control. The debt stack reaches a point where honest servicing becomes politically impossible. Interest costs rise. People feel squeezed. Markets demand higher yield. The state faces the real choice. Admit the loss through default or austerity, or hide the loss through debasement and financial repression. Stage 4, the outcome. Confidence migrates. Not because people are greedy, but because they're rational. They move toward scarcity, toward assets that can't be printed, toward anything that functions as a parallel store of value. And the assets that were dismissed as boring, metals, commodities, hard collateral, often reprice the fastest. That is the machine, and silver is special inside this machine for one reason. It's not just money in people's heads, it's also an industrial input. So it gets pulled by fear and by factories. That dual demand is what turns a tight market into an explosive one when sentiment shifts. Now, I promised proof. 3 receipts. Same checklist. Receipt number 1, Rome. In the early strength of the Roman Empire, the denarius had credibility because its metal content held relatively steady, and the empire's trade and taxation created real demand for Roman coin. Foundation, then expansion. Rome's obligations grew. Longer wars, expensive borders, massive public expectations, the political need to keep soldiers paid and citizens fed. Raising taxes too hard risked revolt. Cutting benefits risked instability. So Rome took the quiet path. Reduced the silver content of the coin while keeping the face value. That's not a one-time trick. It's an addiction. Once the state learns it can fund obligations by watering down the money, the temptation becomes permanent, then loss of control. As debasement continued, prices adjusted. Soldiers demanded higher pay. Merchants demanded more coins for the same goods. The state responded by debasing more to cover higher nominal costs. That loop feeds itself. Debase, prices rise. Debase again, trust erodes. And then the outcome, commerce fractures, barter starts creeping in, tax collection becomes harder, and the state leans toward coercion. Price controls, forced labor, tighter control. Because trust, once broken, has to be replaced with force. Rome didn't fall because of one coin. Rome fell under multiple pressures. But the monetary mechanism is clear. A state that funds promises by degrading currency eventually degrades trust. And trust is the invisible infrastructure of an economy. Receipt number 2, Weimar Germany. Germany after World War I was trapped. Economic damage, political fragility, external obligations, internal unrest. The foundation was already cracked, but there was still a currency and a functioning state. Then expansion, monetary financing. More marks chasing limited goods. Money stops being a measuring stick and becomes a flood. Then loss of control, fast. Confidence drops, velocity rises. People spend currency immediately because holding it guarantees loss. That accelerates inflation even without new printing. And then the state prints even more to keep up, which destroys confidence further. Doom loop. Outcome. Currency stops functioning as money. Savings get annihilated. And in that environment, anything scarce becomes a parallel currency. Foreign money, commodities, gold, whatever can hold value becomes the lifeboat. That's not ideology, that's survival logic. Receipt number 3, the United States, 1970s into 1980, because it ties directly to silver. Foundation, Bretton Woods. The dollar was anchored to gold for international settlement, and much of the world held dollars as reserves. Trust was high because convertibility implied constraint. Expansion. Fiscal commitments pile up. Dollars issued abroad grow faster than gold reserves. Foreign holders question convertibility. The reserve currency trap. You can export your currency until the world asks to redeem the promise. Loss of control. 1971. Gold convertibility is suspended. Nixon shock removing the external discipline. Then the 1970s deliver inflation pressure and a collapse in monetary confidence. Outcome, hard assets reprice. Gold surges. Silver, smaller, more volatile, partly monetary, partly industrial, moves violently, culminating in a dramatic spike around 1980. The Hunt brothers story is usually told like a spectacle, but the deeper point is structural. When confidence in currency weakens, capital searches for scarcity, and thin markets can reprice explosively. 3 different eras, same checklist. Now I'm going to do the part that makes this video different. We apply the exact same mechanism to right now, and we treat it like a cold audit. And after each step, I'm going to say one word. Because this is where most people try to escape into feelings. Foundation first. The foundation of the modern system wasn't gold coins for everyday people. It was credibility. Decades where inflation felt manageable, purchasing power felt stable enough, and central banks were seen as guardians of the currency. People internalized the idea that money was safe to hold. That's the psychological anchor. Now, expansion, read the numbers again. U.S. debt around $38. $567 trillion by official Treasury reporting. Global debt around $251 trillion, still above 235% of world GDP. Those numbers mean the system is trained to survive by refinancing, not repaying. Rolling, not retiring. Liquidity becomes life support. That's expansion. Check. Now loss of control. This is where people misunderstand what loss of control looks like in a modern, sophisticated system. It doesn't have to be movie scene hyperinflation. Loss of control can simply mean the policy menu shrinks until the only politically survivable choices are the ones that quietly tax savers. Think about the levers a heavily indebted state has: raise taxes aggressively, cut spending aggressively, default outright, or reduce the real burden through inflation, currency dilution, and financial repression. Default is politically catastrophic. Austerity at scale is politically suicidal. So the system drifts, almost automatically, toward the levers that hide the pain. That drift isn't conspiracy, it's incentive alignment, undeniable. Now the outcome phase begins, not all at once, but as a migration. Capital starts moving toward scarcity. People start asking different questions. Not how high can my portfolio go, but what can't be diluted? What can't be created by policy? What holds value if trust cracks? And this is where silver becomes an unusually sensitive instrument because it's both monetary metal and industrial input. Now let's connect the dealer's big news to real structure. And when a trust shift begins, the first buyers are the obvious ones. Stackers, contrarians, people already skeptical. They buy early, quietly. That phase doesn't make headlines. Then something changes. A second wave shows up. Ordinary people who don't feel stable anymore. They don't come because of a chart. They come because their lived reality doesn't match official narratives. Their grocery bill doesn't feel contained. Their rent doesn't feel temporary. Their insurance doesn't feel transitory. When that second wave arrives, the physical market starts acting strange. Premiums detach from spot. Inventory turns available into available if you wait. Delivery times extend. Dealers stop sounding like salespeople and start sounding like logistics managers. Here's what we can actually source. That's not a meme. That's a stress signal. Verified. But there's another layer that makes silver particularly combustible. The supply-demand squeeze on the physical side. According to the Silver Institute, in 2024, global silver mine production was about 819, 7 million ounces, recycling about 193, 9 million ounces, while total demand was about 16 billion ounces. Industrial demand alone hit a record 680, 5 million ounces in 2024, pushed by electronics, electrical demand, PV, grid investment, and tech-linked end uses. Now, I'm going to be careful here. Markets have inventories, flows, and accounting categories that don't collapse into one subtraction. But the direction is what matters. Structurally tight markets become fragile when investment demand surges. That fragility is how you get sudden repricing. Check. And remember, industrial demand doesn't politely step aside when investors show up. A factory can't tell its supply chain, "We'll wait until the macro calms down." Silver is used in small amounts across massive volumes of tech and infrastructure. A portion becomes unrecoverable at scale, at least quickly. That means the physical supply chain can become sticky, undeniable. Now here's the retention critical part, because this is where most scripts go flat. I'm going to give you the 2 reasons silver tends to shock people, and then I'm going to give you the one risk nobody talks about. Reason 1, silver's market is smaller than people intuitively assume. It doesn't take the whole world buying to move it. It takes a relatively modest shift in capital allocation compared to what flows through equities, bonds, or real estate. That's why silver can feel asleep for years and then move like it's possessed. Reason 2, silver lives in 2 worlds. It behaves like a monetary metal when fear rises, and like an industrial metal when build-out accelerates. In certain phases, both forces pull in the same direction. That's when the repricing can become violent. And now the risk? Silver's volatility is a weapon that cuts both ways. In a mania phase, it can overshoot fundamentals and correct hard. That's not a reason to ignore the signal. It's a reason to respect position sizing and time horizon. This is educational, not personal financial advice. The goal is to understand the machine so you don't get blindsided by it. Now let's do the present-day checklist one more time, cleanly, so you can feel how inevitable it is. Foundation. Credibility was the anchor, stable enough purchasing power and belief in central bank control. Expansion. Debt and promises stack until refinancing becomes the system's oxygen. U.S. debt, roughly $38. 567T, global debt about 250T and above 235% of global GDP. Check. Loss of control. Policy options narrow. Stealth transfer becomes the path of least resistance. Managed inflation, suppressed yields, subtle currency dilution. Undeniable. Outcome? Trust begins migrating toward scarcity. Silver gets pulled by monetary demand and industrial demand simultaneously. Physical tightness makes repricing sharper. Silver has already been reported in triple-digit territory in January 2026. Behavior consistent with a system transition. Verified. Now let's dismantle the comforting myths, the ones that lower people's guard at exactly the wrong time. This time is different because American exceptionalism. Reserve currency status can delay consequences, but it cannot repeal the arithmetic of debt. If anything, it spreads consequences globally and turns what would be a local adjustment into a geopolitical one. This time is different because technology will save us. Technology can boost productivity, but it doesn't automatically erase legacy obligations, and it doesn't stop policymakers from choosing the path that preserves political stability over currency purity. This time is different because central banks are smarter. Central banks are constrained by employment, markets, politics, and debt sensitivity. Smarter doesn't mean free. It means better at delaying the moment the public notices the transfer. So what do you do with this? You don't panic. You don't become a doomer. You don't treat silver like a lottery ticket. You do 3 practical things. First, you stop thinking in daily predictions and start thinking in phases. Ask, what phase is the system in, and what assets historically reprice in that phase? Second, you track the difference between paper signals and physical signals. Spot price matters, but so do premiums, delivery times, dealer inventories, and how people are behaving at the retail level. When the physical market acts weird, it's telling you something. Third, if you participate, you respect risk. Volatility is real. You size positions like an adult. You avoid leverage you don't understand. You decide whether you're hedging, speculating, or preserving purchasing power, because those are different games. And here's the final warning, the one I want you to sit with. You don't get to opt out of the cycle. You only get to choose whether you recognize it early or pay for it late. The foundation builds trust. Expansion abuses it. Loss of control reveals the trap. And the outcome is the repricing of reality. That is why the dealer's big news matters. Not because a dealer is a prophet, because dealers sit at the edge of the physical market, where reality leaks through first. So here's my ask. If you want the next piece of this map, how the machine was built, why silver is uniquely positioned in this phase, and what typically happens in the next stage, subscribe and watch the next video. Because the people who get hurt in these cycles aren't the ones who were wrong about a price target. They're the ones who were wrong about the phase. And if you're still telling yourself, I've got time, understand this. When the checklist starts getting marked in ink, time is the one thing the system doesn't refund.